Hello, everyone. I'm Kevin Mofid, Head of Industrial and Logistics Research for Savills. I have a short presentation just looking at some of the drivers of the industrial and logistics market, both nationally and within the West Midlands area, which will hopefully set the scene for the discussion that follows. Apologies for the background. You can see removals boxes and so on. I recently became a cliche of lockdown and sold up in the city and moved to the country. With 9-month-old twins, it's been pretty hard to unpack. So I think we'll take my camera off for the remainder of this presentation, so you don't have to see that. But what I'm going to do is just talk through some market stats, market overview, and offer my opinion on where we're heading. The first thing to say really is that the market is doing exceptionally well. At a nationwide level, we've had 38.6 million square feet of warehouse space transacted so far this year. That's at the end of Q3, setting a new national annual average with a quarter left. So, it's already a record. It's going to be the best year ever. But combined with that, vacancy is falling. That's a good thing if you're a landlord or a developer, an investor. Not necessarily a good thing if you're an occupier of warehouse space, which I'll come on to in a few slides' time. What's driving all of this? Well, look, the key thing to say really is online sales. What you can see from this chart is that since lockdown, some weeks have seen 70% growth in the level of online sales compared to the same week in 2019. The red line, that's the average, it's trending downwards, but it's still 40% higher than it was. What's even more interesting, this data set doesn't include Amazon, it doesn't include the grocers. Let's assume they're doing pretty well. This is everybody else. So it's showing that there's that healthy demand for online retail across the board. And that's having a big impact on the amount of warehouse space taken, as I've already said. This is requirements. We track every single requirement for warehouse space. This is every requirement since Christmas. The only thing I want to draw your attention to here is the red line. You can see how requirements fell off a cliff in the first lockdown back in March, April. They're now higher than they were at the start of the year. But also, speaking to our agency teams, the requirements that are in the market are very serious requirements. You're not going to view a warehouse at the moment unless you have to. So you have this double whammy that A, there are more requirements, but B, they're very serious and very committed requirements as well. That paints a very rosy picture for future demand, in my opinion. This has had an impact on the levels of take-up taken. As I said, we're already at a record year. Two caveats, if I will. Of that space taken, 29% of it has been Amazon. So, a big driver of the market, that's floor space. If we look at this by deal count, however, Amazon is 11%. So I think it's very important to say that Amazon, yes, they're a key driver, but by deal count, 90% of the market almost is not Amazon. At the start of lockdown, everybody was saying it was about short-term requirements, short-term deals. And yes, we have had some, but actually only 5.5 million square feet has been for deals under 5 years. 2.8 million square feet for deals under 12 months. So yes, an impact, but not the driver of the market that we thought it could have been. If we look at the West Midlands, the West Midlands has had an interesting time recently. The West Midlands is more dominated by the automotive, aerospace, manufacturing sectors, and we did see take-up fall, pre-Brexit, and it hasn't quite recovered to where it's been. But look where we are now at the end of Q3. Again, we're on the same level as 2019, with action still to come in Q4. We're definitely going to beat the last 2 years, which is a very good sign for the West Midlands industrial and logistics property market. And who's taking space? Well, a very diverse mix of tenants. You can see online retailers, budget retailers, logistics companies, manufacturers, a whole myriad of different people taking space. And this is the impact of COVID in some respects. People are some people are in crisis mode, some people are in expansion mode, but that is driving the market in so many different ways. I think it's important to say we've got Christmas Christmas, Black Friday, that is going to have an impact, particularly on the retail sector. Consumer confidence, consumer spending, this is all going to impact demand into 2021 and beyond. Moving on to our next slide, is the market in balance? And if we just click through here, you can see West Midlands 10-year take-up by occupier type, and you can see, heavily skewed 3PLs, automotives, manufacturers, and as I've said before, given where we are at the moment in terms of COVID and its impact on certain industries, what is that going to mean for the makeup of the tenant base in the sector, in the geography, over the next 2 or 3 years? If we move on to supply, click through here. Supply is relatively stable. It's risen ever so slightly on an annual basis, but it has come down to 34.4 million square feet, giving us a vacancy rate of 6%. This is nowhere near where we were after the GFC, when supply was almost 100 million square feet and you had a vacancy rate of 25%. So again, very, very different times to where we were now. If we just delve a bit deeper into the West Midlands in isolation, you can see here you've got supply has been increasing, but again has come away from its recent peak. And if I just draw on here the amount of stock that is grade A, actually only half of the supply is grade A. So yes, supply has risen, but actually, is it what people want? Is it modern grade A, fit for purpose warehousing? We think actually this lack of supply for the grade A stock will potentially become a pinch point as people look to improve their supply chains moving forward. And again, I'm not going to spend too much time on this because you'll get sent the slides by email, and if you don't, you can contact me. But if we just look across the West Midlands region, you can see how that varies because those numbers, 200,000 square feet, that's actually just one building, maybe two, depending on the size of the buildings. So yes, again, it looks like there's a lot of supply in the region as a whole, but when you delve a bit deeper, it's not necessarily the case. And occupiers may not be able to take the buildings that they want to take in the markets that they want to take them. And that's a barrier to growth. Again, national vacancy. Apologies if you're colorblind, but vacancy is falling in every region that we cover. It does vary. The West Midlands does have the highest vacancy rate, but it is falling. It was at around 10%. It's now down at around 9%. I'll come on to why I think that's important in a few slides' time. Again, if we just look at development, there's 6.8 million square feet under construction at the moment. But again, look where that is. East Midlands, Yorkshire, London. Very, very little coming forward in the West Midlands to satisfy the demand that is clearly there for this warehouse space. And again, it's another indicator that leads me to believe there will be a grade A pinch point as long as demand stays at a similar level to what it's been recently. Now, I explained about vacancy and why that's important, and rents have never increased when vacancy has been above 12%, and that's using data that goes back to 1981. So what we're saying is really when vacancy gets above 12%, that's when you move from a landlord's market to an occupier's market. The West Midlands, yes, it has a higher vacancy rate at 9%, but is it going to get to that 12%? So we've done some modelling that allows us to forecast vacancy into the future, because if we look at these rental growth forecasts, West Midlands 2.8% a year still forecast, and that's because of that vacancy position less than 12%. Click through here now. Again, I want to focus on the manufacturing sector because again, that's a key driver of demand in the West Midlands region. Typically speaking, manufacturers account for 24% of warehouse space. This year, 2020, it's only been 13%, and we've seen very little activity from manufacturers and automotive companies. However, Savills have released a paper on this, and what we've identified is that as investment in UK manufacturing increases, so does the ripple effect for the demand for warehouse space. And this is really important at the moment because there's a lot of noise about nearshoring, bringing manufacturing closer to home, and if that does happen, we're not saying it will happen, but if it does happen, it's definitely going to have an impact on the amount of warehouse space needed. And actually, what we've identified is that for every £1 billion invested in UK manufacturing, this creates a need for an additional 175,000 square feet of warehouse space. So clearly, if people are going to start to manufacture closer to home, that's going to be a driver of demand for warehouse space, particularly in the West Midlands region, which is exposed to the manufacturing sectors and automotive sectors. So my last slide, I just want to talk really about some of the forgotten issues. We've spent a lot of time talking about COVID this year, and rightly so, but it's had a huge impact. But there were some other huge issues as well that were hugely newsworthy. And if I just click through these now and begin to talk about them, Brexit. We saw 2019, the year of the logistics company, stockpiling, all of those type of things. That is clearly going to rear its head again. And by the time this is broadcast, you never know. We may have news on the trade deal that that is due to be signed. Sustainability, a key factor. ESG. Occupiers wanting to occupy greener space, be net zero. Labor automation. Again, COVID is going to have an impact on labour markets. Where are people going to choose to live? Are they going to return to other parts of Europe? Will that drain the pool of warehouse workers? If it does that push us to automation? It may do, but can people afford the automation? Do we have the energy for automation? And then my last point, just upon the automotive sector, and this really relates back to what I was saying about manufacturing investment. Those drivers around electric cars, battery production, R&D, they haven't gone away. And so I expect that to come back onto the agenda in a big way in 2021 and beyond, and start to have that ripple effect moving forward. So I hope that sets the scene for the discussion today. I'll now be chairing a panel discussion, and yeah, thank you very much. See you in the live room.